Hi, I'm Paul Morton. Welcome to InvitAdvisor Office Hours. Today we will compare a few different account types. The more information that you have about how each one of the account types works, then I believe the better decisions that you will make on all of these particular accounts. And so the three accounts that we'll look at today is a taxable account. A lot of people have these in the form of maybe even a checking or a savings account or a brokerage account, an account where you can put multiple different types of securities in, stocks, bonds, different funds, etc. An IRA, an individual retirement arrangement or an individual retirement account, and a Roth IRA, a Roth individual retirement arrangement. And so the contribution limits is one of the things that we're looking at. On a savings account or a brokerage account, there's no limit to how much you can put into these on an annual basis. As long as you can afford the contribution, there's not going to be a limitation that the government is going to provide. And the taxable nature of the contribution. You pay your taxes and then you contribute. So there are after-tax contributions into these brokerage accounts. The growth tax treatment on a taxable account, it's going to follow the capital gains tax rules. So that may be on the gain, there's no tax until a security or position is sold, and that's fine. And so then that same thing with the distributions. It falls under the capital gains taxation. So if there's no movement, if a stock is purchased and just wait for a long time and then it's sold later down the line, that might trigger capital gains tax. So there is no early withdrawal penalty, and there are no required minimum distributions. So with the brokerage accounts, the taxable accounts, there is no government mandate that states you cannot access the money for certain periods of time, and then there's no government mandates that state you must withdraw the money for certain periods of time. And then at your passing, the account will pass to whoever your heirs may be of your choosing, and really any way of your choosing. It can just be through probate court if you don't have a will. It can be through trust or will. And then you can also attach beneficiaries to these in the form of what's called a TOD or transfer on death beneficiary. Next, we have IRA, and we'll go through this same line. The contributions are limited, and so the IRS gives a certain limitation to the amount of contributions that you can make to any IRA at the beginning of each tax year. And the contributions for tax purposes on an IRA, typically a traditional IRA will be tax deferred, but you can choose. You can put your contribution into an IRA after tax, so you actually do have the choice to contribute to these tax deferred or after tax. Most popularly will be the tax deferred option. And then the growth. The growth is tax deferred, so it doesn't matter how many times a position is sold. There's going to be no tax on that growth while it's in the IRA, while it's in this tax wrapper. In an IRA, a Roth IRA, those just state the tax deferred nature on these accounts. And distributions will be taxed as income. However, if there's an after-tax contribution, that's noted in the account, and so then that will be received as basically a return of your own capital. But then all growth and all tax deferred contributions will come out as income and be taxed as income. There are penalties. There's a 10% penalty if you withdraw the funds prior to age 59 and a half. And then there is a 25% penalty if you don't take enough money by the age of 73. So there's about a 13.5-year window where there are no penalties for early withdrawal or not withdrawing enough. And then the IRAs are typically passed by beneficiary law. So you name a beneficiary on your IRA, and then that's who the money goes to. Next is a Roth IRA. And a Roth IRA is basically the inverse or the opposite of an IRA. So again, the Roth IRA will have very similar, if not the exact same limitations as the IRA on how much you can contribute. And then the tax nature is going to be after tax. In no way, shape, or form are Roth IRAs ever tax deductible. It will always follow just like a taxable account. You pay your taxes and then you contribute to the Roth IRA. The growth is just like an IRA. It's tax deferred. It doesn't matter how many times a security is bought and sold and moved, there's going to be no taxes on the growth inside of these accounts while the funds are inside of the Roth IRA. And this is one of the areas where the Roth IRA deviates from the traditional IRA, is all of the income, all of the distributions are tax-free. You don't pay taxes once the money's in that Roth IRA and it's available for distribution. There's going to be no income tax. So the early withdrawal penalty, there is an early withdrawal penalty on a Roth IRA. And you have to have a Roth IRA of any kind open for at least 5 years. It doesn't have to be this Roth IRA. It's a Roth IRA open for 5 years or at age 59 and a half. As long as you get to 5 years of having a Roth IRA or to age 59 and a half, whichever is shorter. So if you're 30 years old, you set up a Roth IRA and then 5 years goes by, you can access the money. And the way you access the money is you can only access your basis. You can access what you've put in, what you've contributed, and that's a return of your own capital, and there's no tax on that. And then once age 59 and a half rolls around, then all of the growth as well will become income tax free. Since there's no taxes on the distributions, the government's not waiting for you to withdraw the money and pay taxes. So there is no required minimum distribution on these Roth IRAs. And then the Roth IRA, just like a traditional IRA, they pass by beneficiary law. So you will name a beneficiary and then that's who the money goes to. And so I hope this is helpful. Again, we have a taxable account. That could be like a brokerage account. It could be like a savings account, an IRA, and a Roth IRA. And the more information that we have on all of these accounts, then the better decisions that we're going to be able to make. Thank you for watching. I'm Paul Morton with Emmett Advisor.